we begin with a big earnings alert on Uber. The company just announced on its earnings call it expects to be EBITDA profitable by the fourth quarter of this year. Oh, that's a full year earlier than expected. Shares popping on the news, giving a little bit back, but nonetheless, well into the green, about 3.5%. Kate Rooney following it all in San Francisco and has more for us tonight. Hi, Kate.
That's right. Hey, Scott, the big highlight from the call just now, Uber CEO Dara Khosrowshahi moving up the timeline for profitability.
Our progress in 2019 and our 2020 plans gives me the confidence to challenge our teams to accelerate our EBITDA profitability target from full year 2021 to Q4 2020.
So moving the goalposts there, some other highlights from the quarter. Uber's still losing money, but not as much as expected. A better than expected EPS loss. That was a beat by 4 cents. On revenue, mostly in line, and full year losses for 2019 came in at $1.1 billion. Gross bookings were a miss, though. We also saw some decelerating growth rates, and the CEO just saying on the call as well that they had sort of a tempered outlook about gross bookings for next year, and you can see the stock fell a little bit on that. I just got off the phone with a few analysts that are saying that's the reason for that. And Uber Eats as well, a big loss from Uber Eats in the quarter, which was expected. That was $461 million, almost doubling from the comparable quarter a year earlier. But again, Uber CEO drawing a line in the sand and saying that last quarter and this current Q1 quarter would be peak losses for Uber Eats. Scott?
All right. We appreciate it. Kate Rooney, thanks. So, Dan, you tell me, I mean, smaller than expected loss. You pull forward by a year your EBITDA profitability map.
Yeah.
And the stock's not getting that huge.
On that, though? But didn't they, when Lyft reported last year and then the November quarter, they were almost forced when they were put on the spot to kind of match what Lyft said? Didn't they already tell us this?
Yeah, well, but they're actually pulling it forward another year now. And I think what's going on here is that I think Dara caught a lot of heat because the Lyft guys got out in front of their profitability target and they were pretty firm about it. I'll just say this, the stock was trading up 10% maybe 15 minutes ago. It's come in a little bit. I think that 2020 guidance was a little softer than expected. So that's one thing. So
Eats is an anvil.
Yeah, well, right? and that's the thing. I mean, he's saying a lot of things like we're going to accelerate M&A to kind of quicken that path to profitability. There's a lot of things that have to happen. And let's remember, this is called adjusted EBITDA. This is not a really particularly sound earnings metrics one way or another. So listen, this stock, went down, got cut in half from its IPO to its lows in November 6th. That was into its IPO lockup. It's rallied about 50%. I think the pendulum has kind of shifted here, and now the company really has to put up. They caught up, at least from a sentiment standpoint, as far as what investors were thinking about profitability to their main rival, and now here they are, and now they have to put up.
Well, let's talk about that setup a little bit, too, because if you look at Uber versus Lyft, just from a technical perspective, you have Uber above the 200-day. Lyft is the complete opposite. It's below the downward-sloping 200-day moving average. It actually tested it almost to the dollar and failed. And they both trade for about 4.5 times sales. So you're getting a very similar valuation. Now, the question is, do you value the optionality in Uber's other businesses? And that's the key. Do you want focused, or do you want Uber, which is trying to do a lot of things? I like the idea that Uber is starting to rationalize some of those businesses. We're all familiar with what they did in India. They're cutting costs from a headcount perspective. So I actually like Uber here if you can be patient and deal with some interim volatility.
Yeah, but some of that optionality is the reason it was being priced at a discount. So it's hard to know. And yeah, maybe the expense load attached to Uber Eats is going to be better in 2020 than expected. They sold the assets in India, which were definitely an anvil. Nice word, Scott.
Thank you.
But I think you have a case here where the outperformance of almost 1,200 basis points against Lyft. I think you've kind of had some of that run. As much as it seems sentiment has turned and maybe gets to a place where people want to look at the operational leverage in this company, because that's really what you're talking about. If you get to a place where the incremental unit revenue dynamics in the U.S. are getting better, look, a lot of this flows straight through to the EBITDA line once they get there. That's what people could do, and you could see analysts coming out there to do it. But I think the stock's had a massive turnaround in sentiment.
Welcome, Scott.
Thank you, Guy.
Good to have you here.
Great to be here.
And I expect to be playing tight end for the Giants this time next year. That's probably not going to happen either. And there's a long way from now till then, and this stock's going to have a lot of ups and downs. I think you're getting a gift right now. The stock's up 53% since the November 14th low. I say you take the money and run here, and you stay with Lyft, which is something we've been saying for a while. I don't think Lyft is getting back to that $63 level where it broke down from after what was a very good quarter last summer, but I think it's going to get close. So if playing Would You Rather, which we are right now, I would rather Lyft than Uber
And Mark
right here.
Bavaro turning in his grave right now.
No, first of all, he's not turning in his grave. He's still alive, and he happens to be a huge Fast Money fan, Tim. Back to you, Scott.
The reference being how you can't even put yourself in the tight end spot. Anyway,
Can you really ever escape the fact with Uber that it went public too late? That it was already pretty mature by the time it went public, and it's always going to be fighting against that.
When you're seeing that over and over again, and I know we're going to talk about SoftBank in a little bit, but it's the funding environment for these later stage companies that are still private is more difficult. This may not be a huge impact, but when you think about DoorDash, Postmates, these are main competitors in the food delivery space. So maybe the more difficult funding environment for some of those later stage private companies is on the margin a benefit for Uber in that space.
Yeah, well, what about a consolidation in the delivery space helping Eats? If you have some consolidation,
but why is there
with
consolidation?
The competitors?
I mean, it just
you got too many players. You've got too much competition.
Right.
So somehow you would think that at some point somebody has to get together with somebody else, and maybe that helps the Eats business because the competition then disappears by one,
but I think
if not more.
Consolidation is happening for a couple of reasons. Partly because some guys just aren't making money, and I think they're effectively dropping out. So yes, if you get to some place where you can actually have pricing power in the delivery service, I don't think that's coming anytime soon. It's not structurally there.
I just want to make one point about your question, Scott, about did they go public too late? I think it's really important. The last 18 months really shows us that the public markets were a lot more discerning about profitability than the private markets. And so this was a shell game. Rates were really low. You had massive infrastructures like SoftBank's Vision Fund doing this. This was, they were just pushing the whole thing forward. So you tell me in 2019, if Uber had $13 billion in revenues and a net income loss of $4 billion, how would the public markets have treated greater losses on greater percentage of revenue, let's say a year or two ago? Not particularly well is my guess for, if you think about it that way, because if you go back and look at some of the ones that went public in the last few years, Twitter all the way back to 2012, Snap, and there's a whole host of others. The public markets have not been particularly kind, especially relative to the broad market for those
I hear
names.
you, but people like Mark Cuban would say they went public too late after the bulk of the growth had already happened. Investors were essentially paying for...
And everybody owned it.
Well, right.
Yeah, no, I think that's right. And Dan, you're right, because the way that if you think about what's been coming out to the private markets and the way the markets have done that, whether it's WeWork, et cetera, but think about the Federal Reserve and what the Federal. I think private equity's just been given a new stoking of the fire. I mean, we've never had a bigger balance sheet in this country. I mean, these guys have thrown more gas in the fire. I think private equity is going to be running to list because money's free.